Federal retirement income doesn't come from one source, and neither do the taxes. Many federal employees assume retirement automatically means lower taxes. But retirement doesn't eliminate taxes. It simply changes where taxes come from and how they apply. Understanding this structure helps prevent surprises and allows better planning decisions. Federal retirement income is typically taxed across three main sources: your federal pension, your Thrift Savings Plan, and Social Security. Each is treated differently under the tax system. Let's walk through how they work. Federal pension taxation. Your federal pension is generally taxed as ordinary income at the federal level. That means the monthly payments you receive are added to your taxable income each year. One important detail is that a small portion of your pension may be tax-free, representing your after-tax contributions made during service. However, for most retirees, the majority of pension income is taxable. State taxes vary depending on where you live. Some states fully tax federal pensions. Others offer partial exemptions or no tax at all. This is why relocation decisions can have long-term tax implications. A simple way to think about pension taxation is this. Your pension behaves much like a paycheck, except taxes are often not withheld automatically unless you set it up. TSP taxation. Traditional versus Roth. The Thrift Savings Plan is taxed differently depending on whether funds are traditional or Roth. Traditional TSP withdrawals are typically fully taxable as ordinary income. These contributions were made before taxes, so taxes are due when the money comes out. Roth TSP works differently. Qualified Roth withdrawals are generally tax-free because taxes were already paid up front. This difference becomes important when deciding how to withdraw funds in retirement. Two retirees with the same TSP balance may have very different tax outcomes, depending on how their accounts are structured. Another important concept is timing. Large withdrawals in a single year can push income into higher tax brackets. That's why withdrawal sequencing matters, not just total balances. Social Security taxation. Social Security is often misunderstood. Many people believe it's always tax-free. In reality, Social Security may be partially taxable depending on your combined income. Combined income includes adjusted gross income, non-taxable interest, and half of Social Security benefits. When income crosses certain thresholds, up to 85% of Social Security benefits can become taxable. That does not mean 85% is taxed. It means that portion becomes part of your taxable income calculation. For federal retirees with pensions and TSP withdrawals, this often comes as a surprise. Social Security isn't taxed in isolation. It's taxed based on how all income sources interact. Why coordination matters. The biggest mistake retirees make is evaluating each income source separately. Taxes in retirement are interconnected. Pension income affects how Social Security is taxed. TSP withdrawals can change tax brackets. Roth versus traditional decisions can influence long-term flexibility. Two retirees with identical income sources can end up with very different take-home income depending on coordination. That's why tax planning in federal retirement is less about avoiding taxes and more about managing when and how income is taxed. Final takeaway. Federal retirement income is taxed across three main sources: your pension, your TSP, and Social Security. Each follows different rules, but they all interact within the same tax system. Understanding those interactions helps protect purchasing power and reduce unexpected surprises. Retirement doesn't eliminate taxes, but a coordinated strategy can make retirement income far more predictable.